Welcome Cryptopians to Total Crypto Updates, bringing you another video for real deep dives into the crypto industry. Please remember to like, share, and subscribe to help the progress of the channel and community. I can't promise to only speak about crypto, but I can promise everything will be understood. Let's dive into today's very dense crypto update.
A controversial Bitcoin improvement proposal, BIP, aimed at addressing data abuse risks through a soft fork plan. The proposal seeks to introduce measures to mitigate privacy concerns and potential misuse of transaction data on the Bitcoin network. Key details include the BIP's focus on enhancing user privacy by limiting the exposure of sensitive transaction information, which could otherwise be exploited by third parties. The soft fork approach is highlighted as a non-disruptive upgrade method, requiring only miner and node operator consensus to implement changes without altering the blockchain's core protocol. Community reactions to the BIP are mixed, with some developers and users supporting its goals of bolstering privacy and reducing data abuse risks, while others raise concerns about the technical feasibility and potential impacts on network transparency. The market context reflects ongoing discussions in the Bitcoin ecosystem about scalability, privacy, and regulatory pressures, with the proposal emerging amid broader conversations on data security. Implications of the BIP could influence future Bitcoin upgrades, potentially setting precedents for handling data-related vulnerabilities, though its adoption remains uncertain due to the contentious nature of the debate. This soft fork could strengthen Bitcoin's resilience against external threats but at the cost of reduced flexibility, prompting a reevaluation of how the network evolves in a privacy-focused era. F2 Pool co-founder Chun Wang, recognized as the first Bitcoiner to travel to space, has publicly criticized Bitcoin improvement proposal, BIP 444, labeling it a bad idea in a social media post. Wang expressed sadness over developers moving further and further in the wrong direction, highlighting his concerns about the proposal's direction for Bitcoin. BIP 444, introduced by controversial developer Luke-Jr., proposes a temporary soft fork to block the inclusion of arbitrary data in Bitcoin transactions for 1 year. The primary goal is to mitigate legal risks tied to illegal content. Moving on to Citigroup, who has partnered with Coinbase to explore stablecoin payment services for its clients, marking a significant step for a major Wall Street bank in adopting blockchain-based digital dollars. This collaboration follows the passage of the Genius Act earlier this year, which established regulatory frameworks for stablecoins in the United States. The partnership aims to facilitate easier fund movements between fiat and crypto, addressing client demands for programmability, conditional payments, and improved speed and efficiency in global transactions. Debapama Sen, Citi's head of payments, highlighted the growing interest, stating that the bank is exploring solutions to enable on-chain stablecoin payments for our clients, and emphasizing that stablecoins will be another enabler in the digital payment ecosystem and it'll help grow the space, it'll help grow functionality for our clients. This initiative positions stablecoins as a potential cornerstone of future digital payments, bridging traditional banking with blockchain ecosystems. The stablecoin market is experiencing rapid expansion, with Citi revising its forecast to predict tokenized dollars reaching $4 trillion by 2030, up from approximately $308 billion currently. According to DeFi Llama data, the market has grown dramatically from under $5 billion in early 2020 to over $315 billion today, driven by assets like USDT and USDC, which are integral to crypto trading, cross-border payments, and DeFi ecosystems. The Genius Act's 2027 implementation has spurred Wall Street's interest, with competitors like JP Morgan and Bank of America also exploring stablecoin services, and JP Morgan CEO Jamie Dimon noting the bank's plans to be involved despite prior skepticism. Investor enthusiasm is evident in Circle's IPO, where USDC's issuer saw shares surge 167% on debut, achieving a $35 billion market capitalization. These developments signal a broader shift, transforming stablecoins from niche crypto tools into essential financial infrastructure amid increasing regulatory clarity and client demand. The Citi-Coinbase tie-up could accelerate mainstream adoption, reducing friction in global finance and setting a precedent for legacy institutions. Next we have Strategy, formerly known as a traditional enterprise software firm, has transformed under executive chairman Michael Saylor into a publicly traded Bitcoin holding company, channeling nearly all its free cash flow into purchasing Bitcoin funded by convertible debt, preferred stock, and equity issuance. This strategy has led S&P Global Ratings to assign the company a B credit rating, marking it as the first Bitcoin treasury firm to receive a rating from a major credit agency and placing it in speculative, non-investment grade territory due to increased default risk from its Bitcoin-focused balance sheet. Despite a sizable market capitalization and access to capital markets, the B rating falls below the BBB investment grade threshold, with a stable outlook reflecting the company's management of debt maturities, though its fortunes are tied to Bitcoin's trajectory. Saylor described the rating as a historic milestone, while industry figures like Kindly MD, Naka, CEO David Bailey predicted an explosion in market demand for treasury companies, signaling potential institutional acceptance. As of mid-2025, Strategy's Bitcoin holdings are valued at approximately $70 billion against $15 billion in convertible debt and preferred equity, but S&P highlighted a balance sheet paradox with illiquid assets in dollar terms, a currency mismatch where Bitcoin-denominated assets contrast with dollar-based debts and dividends, and a negative total adjusted capital due to Bitcoin's volatility excluding it from equity calculations. Liquidity risks include over $640 million in annual preferred stock dividends across 4 classes, which can be deferred but may lead to governance issues like board representation for shareholders, with 2 classes accruing interest on deferred payments. The company plans to fund these via new equity rather than selling Bitcoin. S&P maintained a stable outlook, noting the next major debt maturity in 2028 and reliance on Bitcoin's price resilience, but warned of potential downgrades from weakened liquidity or heightened debt risks, with upgrades unlikely without increased dollar liquidity and reduced convertible debt dependence. This rating validates Strategy's model while underscoring the high-stakes volatility of crypto treasuries. Now, we have big news for crypto enthusiasts. Western Union is embracing cryptocurrencies by integrating stablecoins and developing a broader digital asset strategy. The company plans to leverage stablecoins to facilitate faster and more cost-effective cross-border payments, addressing inefficiencies in traditional remittance systems. This move aligns with Western Union's long-standing focus on global money transfers, as it seeks to enhance its service offerings amid growing competition from fintech and blockchain-based solutions. Key details include the exploration of stablecoins for settlement and treasury management, which could reduce transaction times and fees compared to conventional methods. The strategy involves partnerships and internal developments to incorporate digital assets, with an emphasis on regulatory compliance and security. Western Union aims to use stablecoins not only for customer transactions but also for operational efficiencies, such as liquidity management. This positions the company to capitalize on the expanding crypto market while maintaining its role in traditional finance. Implications include potential expansion of Western Union's market reach in emerging economies, where remittances are critical, and a shift toward hybrid models blending fiat and digital currencies. By adopting stablecoins, Western Union could redefine remittances, making them as instant as a tweet. Moving on to the New York Stock Exchange, NYSE, has introduced 4 new spot cryptocurrency exchange-traded funds, ETFs, by posting listing notices on Monday, with potential trading starting as early as Tuesday. This development occurred amid a U.S. government shutdown that has significantly reduced the Securities and Exchange Commission's (SEC) operations, limiting it to essential staff and halting typical regulatory processes. The ETFs include the Bitwise Solana Fund, the Canary Capital Litecoin and HBAR Fund, and the Grayscale Solana Trust, which is set to begin trading on Wednesday. These funds provide investors with direct exposure to cryptocurrencies like Solana, Sol, Litecoin, LTC, and Hedera, HBAR, without the need to hold the assets themselves. Notably, some of these ETFs incorporate staking features, enabling the underlying assets to generate rewards while held in the fund. This launch represents the first expansion of spot crypto ETFs beyond Bitcoin and Ethereum since their approvals in 2024, marking a significant evolution in crypto investment options. The ETFs appear to have been enabled through newly established generic listing standards, allowing issuers to proceed without requiring explicit SEC approval for each product. This mechanism streamlines the listing process on exchanges, bypassing the prolonged review typically associated with the SEC. The timing is particularly notable given the shutdown's impact on federal agencies, which had led to assumptions that pending approvals would be delayed. Market reaction was mixed. HBAR's price surged by 8% following the news, while Sol and Lieutenant Colonel experienced 24-hour losses. Implications of these listings extend to the crypto market's maturation, as they facilitate greater accessibility and integration of diverse digital assets into mainstream finance. By leveraging generic standards, issuers have navigated regulatory constraints, suggesting increased resilience in the ETF sector despite governmental disruptions. This could pave the way for further innovations, with other applications for Solana and additional asset-based funds pending on exchanges like Nasdaq and CBOE. Switching subjects to MetaMask, which has launched multi-chain accounts, a new feature designed to enhance user asset management across various blockchain networks. This update significantly improves asset loading speed by 30 times, thanks to an enhanced architecture that supports cross-network functionalities. The feature now includes broader network compatibility, encompassing Ethereum Layer 2 solutions and EVM-compatible chains, with specific support for Solana, a non-EVM network. This expansion allows for seamless integration and improved performance in cross-chain operations, marking a strategic move toward greater interoperability in the crypto ecosystem. Dan Finley, co-founder of MetaMask, stated, "The introduction of multi-chain accounts is a significant step towards enhancing user experience and interoperability in the crypto ecosystem." In the context of the broader crypto market, Ethereum, ETH, is currently priced at $4,101.14, with a market cap of approximately $495 billion and a 12.88% dominance. The multi-chain accounts are expected to boost activity on Ethereum and Solana networks, potentially impacting liquidity and total value locked, TVL. Researchers note that this improved user experience could drive increased adoption of Ethereum Layer 2 networks and attract more developers to EVM-compatible ecosystems, influencing DeFi projects and governance tokens. The launch also hints at future support for Bitcoin-like networks, underscoring MetaMask's ongoing commitment to expanding interoperability without relying on new funding, focusing instead on technological advancements. This could democratize multi-chain access, reducing barriers for everyday users. Next, let's talk politics. Representative R.O. Khanna, D. Caliph, announced plans to introduce legislation banning elected officials from owning or creating cryptocurrencies, framing the proposal as a response to corruption concerns tied to President Donald Trump's pardon of Binance founder Changpeng Zhao. Khanna described the pardon as blatant corruption, alleging that Zhao, a foreign billionaire involved in money laundering and with funds allegedly going to Hamas, Iran, and child abusers, was pardoned while potentially financing Trump's cryptocurrency ventures. He claimed Zhao supported World Liberty Finance, which Khanna called the president's son's cryptocurrency firm, and that they were making millions of dollars on it while Trump is president, stating, "It is so illegal. It is right in our faces." Khanna urged bipartisan action to investigate financial entanglements between the Trump family and Zhao, emphasizing, "I think that people think this is a tech issue. This is not a tech issue. This is a corruption issue. This is money that's going into someone at the White House and the White House having official acts like pardons in exchange." However, Khanna's account contains inaccuracies. Zhao did not serve 4 years in prison. He was sentenced to 4 months. And he did not convict. Instead, he pleaded guilty to money laundering violations as part of a $4.3 billion settlement with the U.S. Department of Justice. This proposal builds on Khanna's earlier 2023 banned Congressional Stock Trading Act, a bipartisan ethics bill that aimed to prevent lawmakers and their families from trading individual stocks, requiring divestment or placement of assets in blind trusts limited to diversified funds or U.S. Treasury securities. Although that measure stalled in committee and was not enacted, it contributed to ongoing bipartisan efforts to restrict stock and crypto trading by officials. Khanna's press office did not respond to requests for the draft legislation or comments on his trading activities. The bill could reshape political ethics in crypto, amid rising scrutiny of officials' digital asset dealings. Onto one of my favorite crypto projects, and its increased volatility in the XRP market, driven by key developments from Ripple and insights from its CEO, Brad Garlinghouse. Ripple has launched Ripple Prime, a global prime brokerage service designed for institutional clients, powered by Ripple's digital asset infrastructure, including payments, crypto custody, and stablecoin capabilities, with XRP at its center. Garlinghouse described this as a step toward building the Internet of Value. Technical analysis indicates XRP's unusual stability, with a recent bounce off the $2.33 support level, signaling potential for a 30% rally to $3.45 or higher. Analyst Tyler Hill YT highlighted a 29% spike in XRP's token burn rate, mirroring a 29% price surge, alongside increased on-chain demand and investor activity, suggesting structural strength and renewed network usage due to institutional traction. Market momentum is further evidenced by a breakout above the $2.55 resistance level, with XRP trading at $2.62 on the 1D chart. Influencer Jack noted rising open interest, OI, and returning whale activity, flipping market sentiment positively. If this momentum persists, targets of $2.80, $3, and beyond are plausible. These factors, combined with Ripple's expansion into traditional finance, point to a potential sustained upward trajectory for XRP, though the article emphasizes preparation for volatility amid ongoing legal and regulatory shifts. Investors are advised to brace for swings as institutional adoption accelerates. Moving on to another crypto favorite, HBAR, the native cryptocurrency of Hedera Hashgraph, rallied over 8% in the last 24 hours to $0.1974, with trading volume more than doubling to $421 million, bucking a broader market decline where Bitcoin fell 0.80% and Ethereum dropped 2.56%. The surge in open interest for HBAR futures increased 29%, and over 55% of Binance traders with open positions were long on HBAR, according to the long-short ratio. This momentum is driven by the upcoming debut of a spot HBAR ETF on the Nasdaq stock market, set to begin trading on Tuesday under the ticker HBR, as announced in a Canary HBAR ETF listing circular. The ETF, sponsored by Canary Capital Group LLC, with BitGo and Coinbase as custodians, provides exposure to the HBAR token. Anthony Scaramucci, CEO of Skybridge Capital, described the development as the sound of inevitability. Hedera Hashgraph operates as a public distributed ledger that achieves consensus differently from traditional blockchains, and the ETF launch marks a significant milestone for HBAR, which has a market value of $8 billion. The rally highlights growing investor interest amid the ETF excitement, positioning HBAR as a standout in a correcting market. This debut could catalyze further adoption of Hedera's unique tech, blending enterprise-grade speed with crypto accessibility, potentially elevating HBAR's role in DeFi and beyond. Let's finish strong with South Korean lawmakers proposing an amendment to the Foreign Exchange Transactions Act to formally recognize stablecoins as a legitimate means of payment, integrating them alongside traditional currencies within the country's legal framework. This regulatory proposal is primarily driven by efforts to curb money laundering and tax evasion associated with stablecoins, particularly those pegged to the US dollar that have been used to bypass financial controls. The bill introduces new oversight mechanisms, linking stablecoins to existing payment regulations to ensure compliance and reduce illicit activities. Key figure Park Sung-hoon from the People's Power Party stated, "This regulatory change could affect the use of stablecoins for financial transactions in South Korea, potentially influencing the broader adoption of stablecoins globally." This move aligns with the Bank of Korea's concerns over stablecoins evading regulatory scrutiny, marking a significant step in addressing historical issues, as South Korea implemented stringent cryptocurrency regulations as early as 2019. In the broader market context, this legislative push reflects a global trend toward regulating stablecoins to integrate them into traditional financial systems, potentially impacting adoption and compliance strategies worldwide. The proposal could foster a more transparent environment, boosting trust in stablecoin transactions. While the content includes unrelated details such as Ethereum's market cap at $494.36 billion, a 2.56% price drop to $4,095.87, and a 19.06% trading volume surge, these do not directly relate to the stablecoin regulation proposal. Overall, the implications include enhanced regulatory oversight that may influence international bodies' approaches to stablecoins in formal economies, promoting their legitimate use while mitigating risks of illegal activities.